Hi there, John Thompson, founder and lead advisor here at SMPL Mortgage. This month's strategy, I'm actually really excited about. This is a really unique product, and we don't normally get excited about products. What we do get excited about is the strategy that goes with a product can be really life changing for clients. It is a little complicated, and it's not for everybody, but it's a wonderful strategy to have kind of in the toolbox, and it's called the offset mortgage. So let me jump into this. We really have this, taking control of cash flow, interest rate, and mortgage payoff. This is really designed for someone who's got significant cash flow, has understands leverage, understands how to create opportunities, use our money, and so forth as well. But anyway, so here's kind of the idea. The traditional mortgage is pretty inflexible, right? So as things change over life, you have this mortgage for 5, 10, 15, 20, 30 years. Your income's changing, needs are changing, life happens, right? So the payments are highly inflexible, right? Extra mortgage payments reduce the term, but don't reduce the next monthly payment. So it doesn't affect your cash flow. And the payment is really set by the servicer. There's no flexibility to skip a payment if you wanted to. At the same time, all the liquidity you have from income tends to earn little or no interest because it's sitting around during the month to be spent. And once you put the money in the home, it's really illiquid, right? So if you put a big chunk of money towards a mortgage, it's no longer liquid, which can create challenges as well. So an access to the home equity you have in the property is costly. You got to sell the home, you got to refinance, and so forth. So this creates a really interesting opportunity, right? And so this opportunity is relatively new in the U.S. It came around for a while. Then disappeared, but it's back now. It's been popular in other parts of the world for many, many years. In fact, it's used very often. But so you can potentially save a significant amount of interest over time. You're utilizing free cash flow to reduce the cost of borrowing. You're paying off the mortgage quickly and more efficiently, but you're still maintaining access, use, and control of your home equity. And then you control when and how you repay the mortgage, right? You can make decisions around it is. And with a really aggressive strategy, you could actually reduce the interest rate cost to really just about nothing if you use the product correctly. So ultimately, you can consolidate debt with it. You direct free cash flow to offset the mortgage interest, and you repay the mortgage at your own pace and so forth. So it takes a good comparison. You got to understand it compared to your current situation. You got to understand the risks and rewards of it and so forth. And it's an analysis we love to do, and I'll give you an example here shortly. So how does it work? Well, you do a comparison versus a simulation that we have access to. You look at all the identity, you identify all the liabilities, balances, you identify free cash flow. And then, of course, you have to consider how important overall liquidity is to your financial needs. And then if it all makes sense at that point, you've done the analysis, then you maybe go forward to this offset mortgage that we call. And then you redirect your cash flow monthly into this mortgage payoff kind of opportunity. So here's an analysis, a case study we've done. So it's a late 50s couple. They have a primary home worth about $780,000. They've got a $624,000 30-year mortgage with a 6.5% interest rate. But they've got a lot of extra cash flow, and they're earning 6% on their other investments. They'd love to pay off the home in the next 7 years to kind of coincide with retirement. They're stable. They make good decisions. They have decent liquidity. So we analyze the all-in-one is what it's called, or the offset mortgage. And the analysis tells us it's going to pay off in about less than 7 years. There's no risk of liquidity repayment because they have access to money all the time. With this product, all the money you put into it, you have immediate access to a line of credit. Of course, they need to continue annual reviews with their advisor. And then, once they've got the home paid off, they can put money into other investments if that was the goal. So the results is this thing pays off in 6.2 years. They've saved almost $514,000 in interest over this process. And so here it is. So here on the left-hand side, you have a traditional mortgage on the right. 560 mortgage, your total interest paid over 30 years. Between the interest and principal, you're going to pay about $1.3 million. In this example over here, you make 5.9 years of payments. Total expenses are the interest of $185 plus, of course, paying off the principal balance. So you're saving about $528,000. It's really, really powerful. Here's a graph that shows kind of how it comes down. So again, just so you understand how it's working, all your extra cash flow is going into the mortgage at the beginning of the month. You slowly draw it out over time to pay your monthly bills, and then you start all over again at the extra month. So in this example, the $6,000 that they had goes into the mortgage every month, and you'll see how quickly the mortgage balance pays down over here. So 7 years, the loan balance is dropping very quickly and how much principal is paid off. And this is just at the back end of it. This is out to month 67. versus the traditional mortgage over here, where the balance is much higher as you get to year 7 and so forth. So here's a minimum payment, but again, they're putting a bunch of extra money into it every month. How much principal is going to be paid and so forth, versus over here where the principal reduced annual 3.3% versus 16.9%. How much of it's going towards interest and so forth. It's again, very, very powerful product. Does require understanding, requires a deep analysis, which we're happy to do and go through it. So that's it. Please reach out, and we'd love to go through a one-on-one with you. Take care.